Graduated income taxes are un-American and abominable.
February 3rd, 1913 was a sinister day in U.S. history. That was the day that the 16th Amendment was ratified, giving Congress the power to lay and collect taxes on our income here in the United States.
There's been a lot of money transferred from the accounts of hardworking Americans to the coffers of the U.S. government from the income tax alone. But worst of all, it created division among Americans. And that's the worst repercussion from the 16th Amendment.
And of course, communism thrives on division. That's how it is born. That's how it perpetuates itself. So it's unsurprising that a graduated income tax is the second plank in the Communist Manifesto. Communists can't survive without a graduated income tax.
So a graduated income tax, that's where the more you make, the more the government takes. And just a simple example of how this works, if we have three different tax brackets, 10, 20, and 30%, and let's say that you have $30,000 of income and that each bracket is going to be assigned $10,000 of that income. So on the first $10,000, you pay 10% tax, which is $1,000. On the last $10,000, you pay 30%, or $3,000. Overall, you pay $6,000 on that. So the more you make, you pay more tax on the last $10,000 than you did on the first $10,000. That's a graduated income tax.
So that's where we hear that common IRS phrase, the more you make, the more we take.
And of course, it's not quite that simple because here in America right now, we have 7 different tax brackets. It's 10, 12, 22, 24, 32, 35, and 37%.
And there's different tax
numbers
brackets for married people and single people, and those filing jointly and those not filing jointly.
Lots of different rules.
It becomes really, really combobulated, but that's what government likes, is to complicate things.
Of course, they're trying to make it all fair.
Well, a pretense of making things fair, but it's actually creating discord in the population.
Because it creates different classes of people. Some people think that they're going to take it all from the rich people. In fact, that's how the income tax was originally passed, as a tax on the rich. You would only pay if you were a very high income earner, and the top tax bracket was 7% in 1913.
And that's another problem with the graduated income tax. It's not a fixed tax. Those brackets that you just talked about, they fluctuated over time.
They did. Even though it started out the top bracket at 7%, by 1918, the top bracket was 77%. And in 1944, 1945, during World War II, the top tax bracket was 94%. And most people didn't pay the 94% tax bracket. You had to make $200,000 to be in the 94% tax bracket. But that would be like making about $3.5 million today, not quite that much. But you look at the other parts of the tax brackets, at that time, they started at 23%. And if you made $10,000, you were in the 41% tax bracket. $10,000 back then would be like $173,000, $174,000 today.
That's almost 6 times more than what it was when the tax was first implemented in 1913, but it was on a much lower income level at that point.
Right. And by the time we got to World War II, you had most people filing income taxes.
Whereas most people weren't in 1913.
Correct.
So yeah, the graduated income tax was sold to the American public as a tax on the rich. And most people did not pay any taxes under the graduated income tax at that time. But it was the proverbial camel's nose under the tent that allowed the government to come in, and it has destroyed American families and American entrepreneurship.
Well, a lot of people, when they're in college, the taxes might sound like a nice thing because tax the rich, evenly distribute the money. But as they're going through college, they're kind of living in this insular bubble. And so we find a lot of people, when they get out and they get their first job and they see how much of the paycheck goes to taxes, that could be an eye-opener then, because now it's their pocketbook. They thought they were socking it to the rich, and they find out even if you just have a job, you're considered one of the rich.
I was just talking to a young man the other day that had been working in a business of his own and recently took a job and was shocked at the amount of money that he had made that's going directly to the government. And this is the other thing about the graduated income tax. It's taken out of our paycheck every month if we have a job, because the government knows that if you had to pay it on April 15th, you either wouldn't have it or you would be shocked at how much money is going to the government that you would revolt.
So this particular young man you're talking about, he actually looked at it and noticed that where many paycheck earners, their money is deposited directly to their bank account, they don't know how much they would have made before the tax was taken out. So that is a huge light bulb when people actually see what that is.
So you talked about a fair tax. What would be a fair tax?
Well, if we go back to the biblical standards for taxes, you had some taxes that were like a flat percentage. The tithe in the Old Testament was a tax in a way because it went to support the Levites, the widows, the orphans.
The
land.
theocratic form of government.
Exactly. So it was a flat tax. It wasn't a graduated tax. The people that did make more, obviously 10% of a lot is more than 10% of a little, but it was a flat tax. It wasn't a graduated income tax where the rich paid much more. And the other way that taxes were paid is when the people were counted and there was a census. Everybody paid the same flat amount. The poor shall not pay less and the rich shall not pay more. Exodus chapter 30 tells us. And the reasoning behind that was that every person was valued equally in God's eyes. There wasn't a difference in persons.
And that was more American, because when the founding fathers got together to create our Constitution, they used the Bible for much of their examples, setting up their government. We had founding fathers that were extremely wealthy, landowners, did very well. There was a story of another founding father who had to take a collection among his friends and neighbors so that he could purchase suitable clothing to show up, to participate in forming the Constitution. So you had a drastic socioeconomic representation there to produce the Constitution. And now, here in 1913, we're suddenly saying, oh no, you're the rich, you're the poor, this is what's going to be different. And it really creates a difference, a noticeable difference, a discord too. Yeah. You're not paying your fair share, or I can't afford it, you better pay my part.
Well, that's why Warren Buffett, likes to talk about how his secretary pays more in income tax than he does. Obviously, that is true. There's two different classes of people. There's Warren Buffett, the investor, very well-to-do, Berkshire Hathaway owner. And then there's his secretary that works for him. But her income tax is all she gets to work with, whereas Warren Buffett has all the exemptions and things that come with owning a business that allow him to keep his taxes much lower and live off of a salary that's lower than what he's paying his secretary.
It's interesting. If the government and the taxes that they create to fund all of their different programs, those programs don't really create value. They take value. There's a great explanation of this phenomenon in the book Economics in One Lesson that talks about the baker whose window is broken by a boy throwing a brick. And the glazier comes to repair it. And the glazier is happy, of course, because just like an undertaker can't necessarily be unhappy about a death because it brings business, the glazier gets business from a broken window. But what is not seen is the fact that the baker might have been planning to buy a suit of clothes with the tailor if his window hadn't been broken. So the breaking of the window did not create business. It simply directed it put it in another direction.
It diverted it.
It's the classic seen versus the unseen.
And in that example, too, instead of something else being created, something that already was just got replaced.
Very true.
And we think of Warren Buffett's secretary. Yes, she might be paying more in income tax, but we can't be displeased with Warren Buffett because who is creating more value for the whole citizenship? I mean, Warren Buffett creates a lot of value with his businesses. Whether we like them or don't like them, it doesn't matter. He's creating value for a lot more people than what his secretary is able to do working for Warren Buffett.
Well, I certainly value Warren Buffett's See's candies.
He owns some railroads and lots of other companies as well.
He does. Pampered Chef, a lot of things that people get a lot of benefit and value from. And when his company pays taxes, we pay those taxes by buying those products.
At the end of the day, taxes destroy wealth. And that's one of the reasons a graduated income tax is so destructive, is because it destroys wealth. If you save $500 a month for 30 years and you're able to earn 8% compound interest on it, you pay a 1.5% management fee. If we look at different tax rates on that and look at the value that is destroyed by taxes, when you get to a 35% tax bracket, more growth is destroyed by taxes than what your account grows by, the growth that you get to keep. When you get to 50%, you're paying as much in taxes as what you get to keep. When you get to 60%, and we've seen the income tax has had rates over 60% in history. When you get to 61%, you have more growth that's destroyed by taxes than your total account balance in this example after 30 years.
That's eye-opening. And most people never see that because they never see the stub that comes with their paycheck that just comes out and goes to the government. And they think, oh, this is all I made for this amount of time.
When we get back from the break, we're going to talk about ways to avoid income taxes, pay income taxes, and fight against the progression of income taxes. We'll be right back.
While we're on break, I wanted to ask you to review the Wealth Talk show on Apple Podcasts. Over the years, we've received several reviews. Most of them were positive, but there are a couple negative ones. And Apple, for some reason, is choosing to feature those reviews, so it looks like our show has a 2-star rating. We're hoping by getting some more recent reviews, Apple will feature those and reflect a more accurate rating for the show overall. So please go and review the Wealth Talk show on Apple Podcasts. We appreciate it very much. Thank you.
Louis Brandeis was a United States Supreme Court justice. This is what he had to say about income taxes. He said, "I live in Alexandria, Virginia. Near the Supreme Court chambers is a toll bridge across the Potomac. When in a rush, I pay the dollar toll and get home early. However, I usually drive outside the downtown section of the city and cross the Potomac on a free bridge. This bridge was placed outside downtown Washington, D.C. area to serve a useful social service, getting drivers to drive an extra mile and help alleviate congestion during rush hour. If I went over the toll bridge and through the barrier without paying the toll, I would be committing tax evasion. If, however, I drive the mile outside the city of Washington, D.C. to the free bridge, I am using a legitimate, logical, and suitable method of tax avoidance. And I am performing a social service by doing so. For my tax evasion, I should be punished to the full extent of the law. For my tax avoidance, I should be commended. The tragedy today is that nobody knows the free bridge exists."
I love that story, the way it talks about such a simple example of how by planning ahead to avoid taxes myself, I actually create a social service with humanity.
And another justice, Learned Hand, said, "There is no patriotic duty to pay the most tax possible. In fact, it is admirable for those who work with their finance to pay the least amount of tax possible because they're doing a social service."
One of the best ways for tax avoidance in our economy today is by having a business and having business expenses, which are deductible, because there's a whole lot more business expenses that are deductible than personal expenses. And even if you're an employee, there's some ways to avoid taxes using tools like life insurance that give you tax deferred growth after the taxes have been paid on the premiums going in. Real estate can offer some tax deductions. And so there are ways that people who work as employees can work toward becoming business owners with favorable tax situation. On the other side of the coin, we have tax evasion. And that would be like the people that go around saying, you really don't have to pay your income taxes because there's a loophole in the way the 16th Amendment was passed.
You put a comma in the wrong spot, and it means this. And yeah, the government.
Those people are testing the system. They could end up going to jail. In fact, we know some people who have.
So having your own business is a really good thing. And what many people fail to realize is that the IRS doesn't care if your business is successful or not. All right. And we shouldn't just set up a business to have a failure, but a business has certain expenses, and those are deductions that you get to take right off the top of what you're generating. And it can help the money that you do make go further.
And I just love the infinite banking concept that Nelson Nash brought to us, and using whole life insurance as a way to create kind of a banking business for anybody who owns a whole life insurance policy. So it can be business owners, it can be employees, but we create this pool of money within our life insurance that we can have access to. And now we get to play the role of the banker. So now we're participating in a banking business, whether we have our own business or are working for somebody else, it doesn't matter. And we have the mindset of a business owner, because now this is a separate entity. It's our banking business, and it can produce and help us to build wealth along the way. Because Tom, you and I, we've always had our own business. And when we started implementing this, we suddenly thought different about our business and our banking business, and how our banking business could loan to our business, and all the tax benefits that went along with that also. So there again, we were being like Louis Brandeis, planning ahead, kind of separating our business from this banking business and being able to use the profits from that.
And using life insurance, like the infinite banking concept prescribes, helps people make the jump from becoming employees to becoming business owners. Because you think about it, it can be hard to accumulate the capital that you need to start some businesses, some business efforts, but using life insurance as a financial tool can help you to do that in an environment that an employee can still access that money when they're ready to make that jump to become a business owner. We've seen people do that many times.
Yes.
And of course, if you're listening to this show and you want to avoid taxes legally, you need to hire professional help, someone that really understands the tax code, whether it's a CPA or whether it's a tax preparer that has a right to represent you in front of the IRS, because you want to make sure you're doing things legally. Tax evasion is a nasty thing to get involved in. You don't want to spend time in a federal prison.
I'd like to, John, what you said a few minutes ago, when we use life insurance where we're saving our money, keeping that money, when we access that money, we're not paying tax on the growth of that money. We pay tax on the income that we make before we purchase the life insurance. And then we don't have to pay tax on any of the growth. And because that's a huge tax, that really cuts into our profits if we're paying a tax on the growth of the money as well.
So many things that employees can put their money into, like tax deferred plans. They can put the money there and it can grow tax deferred, but if they're going to get it, then they got to pay the taxes. Or there's certain restrictions that they can't get it till 59 and a half if they did pay the taxes going in. Let's say it's a Roth IRA. If they did a Roth IRA, they paid the tax going in. That's kind of like life insurance up till that point. But if they're going to go access that money before 59 and a half, they have to follow the rules. If life insurance, you can access the money by taking a policy loan anytime. You don't have to wait till 59 and a half.
I think life insurance, being able to purchase it, kind of takes away this class system that the taxes creates, because you can purchase a policy based on your own income and what you're able to save, saving 10% of your income. Whether you make a large income or a small income, it will provide you with a pool of money with the life insurance that you can access and use. It doesn't matter if you are a rich landholder or if you're
entry-level wage earner.
That's correct.
And everyone that buys the type of life insurance we're talking about, dividend-paying whole life insurance, pays the exact same amount for the risk that they pose to the insurance pool. There's no differentiation between classes. You can be white, you can be black, you can be Asian, you can be anything, and everyone pays the same based upon the risk that your life poses to the pool.
So even people who have medical conditions, they pay according to the risk that they add to the pool. So the playing field is leveled, and that's a great thing. That's a great response to this system created by this tax.
So dividend-paying whole life insurance is a way of planning to avoid taxes in the future. It's also a way to avoid paying taxes right now as we leverage the cash values in our dividend-paying whole life insurance to fund business opportunities or even personal things that we need to take care of in our life.
We had a podcast listener ask us to do a rebuttal to an episode of the Dave Ramsey Show where he talks about the infinite banking concept. We happen to know a lot about the infinite banking concept, so if anybody could add perspective to what Dave Ramsey has to say about the infinite banking concept, it would be us.
And that's exactly what we're going to do right here next week.
We'll respond to Dave Ramsey's video on the infinite banking concept next week, right here on Wealth Talk.